Welcome back, everyone. We better get moving again and try and stick to our timetable. Toby, I think next time maybe we need to serve the scones inside, and that people might come back earlier. We'll see how we go. Before we get underway, just a reminder again that you can scan that QR code on your table to get access to the presentations and other material that's in there for you. Now, we're going to continue our lineup of impressive international speakers. We had someone from the US, we're now going to have someone from the UK. We're talking about different asset classes today. We're going through domestic equities, fixed income, we've had alternatives. In each of them, there's often talk about, well, how well do these managers do? And particularly, of course, do they beat the benchmark, which is what our next speaker is going to talk about. Our next speaker is Tim Edwards. Tim is Managing Director and Global Head of Index Investment Strategy with S&P Dow Jones Indices. Please welcome Tim.
Thank you, David. Good morning. Thank you for investing your time, and I hope to reward it with a few observations and insights on, indeed, this question. Why is it so difficult to beat benchmarks? So here's the agenda. I have 24 minutes and 18 seconds to take you through it. First off, how are actively managed funds doing? How are stock pickers doing around the world and in Australia? Secondly, why is active management so hard? And finally, what can we do about it? So that's the agenda. Let's get started. How are actively managed funds doing? The answer is actually offered on a regular basis by S&P Dow Jones Indices in our SPIVA scorecards. And if I could ask you to exercise your elbows, could you put your hand up if you have heard of SPIVA before? Love you guys. And are your arms working? If you've not heard of SPIVA, can you put your hand up? Okay, well done our marketing teams. There's only about a third who hasn't, so I won't spend too much time on this. What is SPIVA? It's an acronym. It stands for S&P Index versus Active, and it's the brand name for a series of reports that we publish around the world, including in Australia. Every 6 months, we report how many funds, actively managed funds, what percentage beat the appropriate benchmark. And I do emphasize appropriate benchmark. So, you know, a large cap fund gets compared to a large cap benchmark, a small cap fund to a small cap benchmark, and so on. We don't just report these numbers when they suit us, if you like. We do it every 6 months. Sometimes it's good, sometimes it's bad. There is an ongoing and very vigorous debate around the role of active and passive and stock picking in portfolios. We don't aim to settle it, we just aim to inform it with data. So these scorecards show you where active is working, where it isn't. We've got them for all sorts of different markets around the world. We update them semi-annually. They come a little bit late. So we wait for the end of the year, and then we give it a few months to make sure every manager has a chance to report their returns. The latest edition, the Australia 2022 SPIVA scorecard, was published 1 hour and 12 minutes ago. So, breaking news, ladies and gentlemen. How many Aussie funds beat the ASX 200 last year? Well, let's find out. Okay. On page 1 of the report, you'll see a version of this chart, and it gives you just a kind of overview of the main headlines. So this is the yellow bars are showing you the 1-year number, 3 years, 5 years, 10 years, and 15 years. You see a kind of a range of returns not returns, beat rates or underperformance rates in the 1-year horizon, ranging from 58% in Australian Equity General, which is the largest by in number of funds and by assets. Mid and small cap managers actually had a tougher year than they have been used to, with nearly 80% underperforming. International Equity General, again, sort of close to 50, but majority underperformance. Australian bond managers had a bit of a rough year. A-REITs had a bit of a good year. That is the picture as of 2022. I think there is an interesting context in here, which I will not spend too much time on. But those of you who have been following the vigorous and entertaining debate between the role of active and passive might have heard a few arguments. That you might have heard that, look, it's fine in a bull market, yes, stock pickers are going to underperform the market because, you know, the ability to go to cash, the ability to play defense doesn't have a lot of value when it's just market soaring upwards. Or you might have heard that there was just no opportunity for outperformance because everything was correlated, everyone was swimming together. And I think there's some truth to that. Or you may have heard that, and particularly in US markets, well, it doesn't make any sense anymore. You've got these companies like Tesla, they're just flying up at price to sales with silly numbers. Fundamentals don't matter anymore, valuations don't matter anymore, and that's why active managers are struggling. In that context, last year you saw volatility and bear markets. You saw massive dispersion, particularly between different sectors of the market. And you saw, for the first time in nearly 15 years, you saw a fantastic year for value investing. So In that context, I think the fact that 58% of Australian equity general managers still underperformed gives you an indication of how hard it really is to beat benchmarks. So how does this year compare to other years? So we've been producing our scorecard for Australia for 10 years now. Here's 10 years of beat rates in, again, that largest category, Australian equity general. Sometimes lower, sometimes higher. 58% is pretty close to the long-term average of that series, which is 57%. So yeah, not a new Eden, shall we say. The challenge is not just to find an outperforming manager who outperforms one year or the next year, but to find one that persistently does so. And here I will advertise our persistent scorecard, companion report. The one for last year will come out in a month or two. And what that looks at is, do winning funds keep winning? What does the data tell us? So some summary statistics. What this does is it looks at, you start off, you pick a point in time, full year, you take all the funds that were in the top half of the distribution, so the winners, relatively. How many of them stayed in the top half the year after, the year after, the year after, and the year after? And a useful comparison point here, because it's top half versus bottom half, is versus a coin flip. Like how many times did you get heads 4 times in a row? So the yellow line shows you what you'd expect under a coin flip. The blue bars are the persistent statistics in various categories. Look, some higher, some lower, but the point here, statistically, is there's not much evidence of persistence either. So it's hard to find managers that beat the market. It's hard to find them beat persistently. This is a story that is echoed around the world in our reports. So we published the Australia full year just this morning. We haven't done them for the rest of the world. So these are showing you from 6 months ago, most recent numbers. What I want to highlight is, if you, the writing's tiny, the 3 numbers are 1 year, 3 year, and 5 year. If you look at the 5-year numbers all around the world, it's hard to beat benchmarks. Now that's up to 5 years. This year marks a very special anniversary for the indexing community, or very specifically, the ETF community. This January, it marked 30 years since the SPIDER, as it was known at the time, launched. The first ETF tracking the S&P 500, today an absolute giant in the industry, and a product that kicked off an industry which is today worth over $10 trillion at aggregate. Because we at the index business are rather fond of the SPIDER, we thought we'd give it a birthday present. And my team, who produces the SPIDER report, said, let's do and I should say, I don't know if there's anybody that bought SPY, the SPIDER, on the first day it launched and held it for the next 30 years. But if they did, you might well ask, how do they do compared to the available set of US active managers that were offering their funds 30 years ago? So we did that. We just did a very special 30-year edition of SPIVA. Here are the results. And I should say, normally in our SPIVA scorecards, everything gets compared to an appropriate benchmark. So small cap growth, small cap growth fund, small cap growth benchmark. We didn't do that this time. Everything versus the S&P 500. Here are the results. I should say these are a good solid couple of hundred funds, nearly 1,000 in the sample. In the large cap core US category, 98% of funds lagged the S&P 500. Even in categories where they had the tailwinds of a outperformance, small cap, 81% underperformed. Overall, across all domestic funds, 90% underperformed. This is how hard it is to beat a benchmark in the long term. And it also tells you that sometimes tracking the market is described as being settling for average. This is not settling for average. In fact, you'd have been far ahead of the majority of actively managed funds. So let's take a little dig. So if I take that 90% number, you want to know how that happened. Because, and you may well be asking, but Tim, but the spider had a fee of whatever it was, 9 basis points. How much difference would that make? All right, I'll show you. So this is the distribution of all the actively managed US domestic equity funds. There's a distribution of their 30-year annualized returns. And the pie chart shows you 60% of the sample just didn't even survive. Something happened to them. They blew up, they got merged, they got liquidated. So the majority, the most likely outcome for you, if you bought an active fund 30 years ago, is your fund died. If you were lucky to get one of the 40% or so that survived, 0.75% chance, or 75% chance, 3/4 chance, that you underperformed the S&P 500. Would adding a 9 basis point fee make a difference? No, it would not. Now, I've shown this chart a few times in a few places, and I anticipate there is at least one person in this room, probably more, who is wondering, what's that one? I understand why you might be thinking that. You're missing the point. So, not going to tell you. All right. So why is active management so difficult? I'm going to talk very quickly through 4 different concepts: varying rewards to skill, skewness, professionalization, and cost. First, varying rewards to skill. So here are 2 months in the world's oldest index, the Dow, 127 years old. It's got 30 stocks in it, and so I can show to you what happened to the Dow in any given month in red, and all the 30 stocks in grey. First of these, February 2021, peak of the meme stock phenomena. Things were going everywhere, all sorts of fun, crazy things were going on. Very widespread in in constituent performances. The index itself just kind of sailed through. That's diversification happening. On the right-hand side, August 2015, you probably don't remember it. It was a sort of quiet month. August is often quiet for US equity markets. And then all of a sudden, in the middle of the month, Kim Jong-un tried a new rocket, and everyone went, oh, goodness, God, Christ. And what you saw was everything swimming together. Now, if you are a skilled stock picker with insights, which market do you prefer, right? Do you want that one or do you want that one? You want the first one, right? There's a bigger reward to your insight. And dispersion, which is what we call this and we measure it, it does vary over time, right? So that's an important feature. We actually publish a monthly report on dispersion in various markets. It does change a lot. This is a sample. This is what our year-end report looked like, and we sort of made the comment that actually last year there was pretty high dispersion. There was opportunity. That's part of it, right? Managers don't reduce their fees when the opportunities get smaller. When there are big opportunities, more rewards for skill. Okay, return skewness. I think, by the way, this bit coming here, I think is really underappreciated. So please pay attention, I think. Okay. I've got the US and Australia. I'll show you Australia first, actually. So the ASX 200 is about 23 years old. Launched together partnership between S&P and the Australian Stock Exchange. And what I did was I took every stock that was ever a member of the index. Right? So there's more than 200 of them, because it includes things that got kicked out or came in later. And I looked at the full period total return of all those constituents. So this is the potential of chart crime here. Some of these are like from IPO to the end of the period. Some of these are from the start of the period to whenever they died. Some of these are a full 20. It's a mix of returns here, but that doesn't matter. What's important is the skew of the distribution. There's roughly a quarter of all the constituents that were ever a member, their returns were down 50 to 100%. Okay? And then you got this really long tail, and you got about 4.5% of stocks that went up 10x or more. There's a very skewed distribution, and it's very natural for equity markets to have this, right? Companies can go down up to 100%. Their gains are unbounded. If I was actually to show you all the returns, I'd need to start that chart there, and I'd need to end it over here at, I think, 14,000% was the top, right? So this is normal, this is natural over the long term, you should expect this. Now, why does this matter to stock picking? It matters because the average and the index gets pulled up by a few absolute superheroes. So imagine, take an extreme version of stock picking. If you're going to just pick one stock, right, and put all your money in one stock, more than 2/3, and you can see it visually, right? You've got 25% down quite a bit, 20% down more. The median was a plus 2% return. And then you can see that roughly 3/4 of all stocks were below average. So your chance of picking an outperformer is 3 to 1 against. That's why it's hard to beat the benchmark. Benchmark, incidentally, if anyone here studies game theory or knows the concept of game theory, there is in here a game theoretical strategy. If you have the insight, the ability to identify whichever it'll be, the 5% or the few stocks that are going to give you 10x returns over the next 20 years or so, you are worth your weight in gold, right? Because you're going to outperform by a fantastic amount. However, if you think you're not really going to be able to reliably identify those absolute superheroes, those few superheroes, what's the best strategy? Buy all of them. That guarantees you participation in the next generation of heroes. And by the end of that period, if it's a market cap weighted index, you'll find that you actually have quite a lot of money invested in those heroes. This isn't unique to the US markets or the Australian markets. If you do analysis like this in the US, in New Zealand, in Japan, in Europe, in the UK, any equity market, you'll get a picture like this. Like, it might be 75% underperforming, it might be 60% underperforming, but you'll get a picture like this. It's something fundamental to equity markets. So that makes it hard to be a stock picker. Next, professionalization. Now, professionalization is important because, take a step back actually. Investing is not a zero-sum game. All of us could invest in a mix of risk assets like equities and defensive assets like bonds, and we could all get rich. Let's hope so. However, outperformance is a zero-sum game. For you to be above average, someone else in this room has to be below average. If you're below average, someone else above this room is above average. And so it becomes important to ask, if I'm investing in the stock market and I need someone else to be below average for me to be above average, how smart is everyone else? What are my chances? The world has changed. I'm not going to go through the full details of this slide, but it's to give you a sense of what's different on the New York Stock Exchange from the 1960s to today. Many of these also apply to America. We used to have no dedicated securities analysts. It's an industry now. We've gone from 0 CFA holders. There's 160,000 CFA holders today, and another nearly 300,000 taking exams. There's 300,000 Bloomberg terminals. There's 100,000 investment professionals, or more. When you are trying to beat the market, what you are trying to do is trying to be smarter than typically someone who works for a hedge fund has a computer plugged in right next to the exchange. There's a CFA and a Bloomberg terminal and a PhD in quantum physics. It's hard to maintain an edge in the markets. There's something else that's changed as well, which is actually, excuse me, the growth in passive investing. So here, just got some stats showing you the amount of money that's indexed to the S&P 500, which is probably the most indexed index in the world. It's grown over time. You know this. It's happened in Australia as well. But think about what happens when an investor, disappointed perhaps with the performance of their stock picker, moves into an index fund. If you're tracking the index, you are removing your supply of alpha to the market. You're going to get the market performance, and so you are not potentially offering your alpha. So, and I think that has actually been the trend. The people who've been moving to indexing have been people who were historically providing alpha. So if you want to keep making outperformance, then you need to rely on finding your outperformance from someone else. And that you basically have a situation where it gets harder and harder and harder to beat the market because the people trying to beat the market get smarter and smarter and smarter, and all the people who weren't doing well move to index funds instead. So professionalization is a big piece of the puzzle. Let's talk about one more piece and then we'll have 3-4 minutes for questions, which is cost. And cost is kind of the inevitable one. I don't want to over-labor this point because it's obvious. Typically, not always, an actively managed fund will cost more than an equivalent passive fund. You can also, some people do, kind of run passive strategies yourself. So close to zero cost. They don't have a lot of trading either. So over short time horizons, like a week, a month, a year, the difference between, say, a 70 or 1%, 70 basis points or 1% fee, or a 5 basis point fee, that difference isn't going to be material in the short term. The difference between, a winning active strategy and an index strategy, if it's a winner, that'll be enough to pay for the fees. But 1% per annum over 30 years becomes a really hard benchmark to beat. So I think cost is part of the story. How material is this? Well, I'll share something we ran as a sort of kind of a hypothetical exercise. So again, apologies, it's just on the S&P 500, but that's where we could get all the good data. So we took all the assets tracking funds, including, for example, the SPDR, but also including index funds, including basically non-listed funds and so on. We took all the assets invested in low-cost index funds based on our main indices, S&P 500, and then we added our mid and small cap indices, 400 and 600. And then we looked at the assets year on year. And then we took a industry statistic, which was the average difference in fees between actively managed US equity funds and passively managed US equity funds. And with those two data sources, we could estimate, we could calculate roughly how much had been saved in fees overall by people using index funds tracking our indices. Would anyone like to guess how big that number is? $403 billion. Bang on. I said, would anyone like to guess? But thank you, that's a spot-on guess. I'll give you two ways to put this number in context. I mean, look, that's a lot of money. Two ways to put this in context. The first, I don't know if anyone here has heard of it, there's a wonderful book written in the 1950s by a former Wall Street broker called Where Are the Customers' Yachts? Well, I worked out, using a bit of Wikipedia and a bit of Google, that if you bought every luxury yacht in the world, you'd have 350 billion left. A colleague of mine pointed out this is actually enough money. It's the World Cup. Maybe you were happy with the result. Maybe you were unhappy. This, you could hire all the stadiums, you could buy all the footballers, and you could keep running the World Cup until Australia won. All right, few more comments. What are we going to do about it? There is an illusion that it's all about do you stock pick or do you not stock pick. And I want to acknowledge that every single one of you is an active investor. When you start, how much equities, how many bonds, what's my need for incomes, what's my risk tolerance, do I want international equities? Do I want to hedge against inflation? What are my needs and when do I need them? These are all active decisions. They're not solved by an index. And the question is, where do you want to be active? Is it in choosing one manager over another, or is it getting the asset mix right and making sure that your investors, your stakeholders, stick to their plan? Those are active requirements. And we did an analysis a couple of years ago, which looked at all the products tracking an S&P index. We looked at the assets, we looked at the trading volumes. The coloring here is by average holding period. For most, the vast majority, the sort of median holding period of an index fund or an ETF, it's a couple of months. Now, of course, that's comprised of some people who trade it all the time and some people who trade it very rarely. But can we just acknowledge that people are using index funds in active ways? right? It's not should you be active or passive, it's where should you be active or passive. The data suggests that it is very hard to find outperforming stock pickers in the long term. The data doesn't suggest that there isn't value in building and constructing portfolios carefully and certainly sticking to plans. And what indices do is they allow even long-term investors to benefit from an ecosystem of traders that scrutinize every decision. So this is the ecosystem for the ASX 200, right? So you've got futures, they traded roughly $2 trillion last year. Options, ETFs, people trade the sectors, sizes, factors. There's a whole ecosystem. If you buy an index fund tracking the ASX 200 and you wait 20 years and then you open the box and see if you're rich or not, what will have happened in the meantime for your investment? Every ad, every drop, every price change, every evolution, every day, every week, every month, an army of people have been scrutinizing every single decision in your portfolio. And that's why it's hard to beat the benchmark. Thank you very much.
Questions for Tim?
Thank you, very well presented. Paul Saliba from Evolutionary Portfolio Services. At what point does everyone indexing create a problem in terms of the index rank is based on active management, it's based on forecasting and estimating for companies to rise up the index and indeed for companies to fall down the index. And if everyone goes to index, then you never have SVB actually get into the index in the first instance, and the day it goes out it is a 100% loss. It doesn't lose its price over time. So where is the tipping point where this becomes problematic for the market in all of those efficiency of
thank you for your
allocation of
question.
capital?
So we need active investors. We need them to police pricing. And there's plenty of them. I think they have evolved. So if you look at SVB, for example, part of what the price on SVB should have been is the very particular circumstances of SVB. But part of it is also the fact that it was a regional bank on the West Coast in the US equity market. All right? And actually, I've kind of already shown, people are trading sectors, industries, countries. So part of one thing that has changed is index using has meant increased price policing at sort of broader macro levels. But to the heart of your question, which is, what if everyone kind of index and also was super passive, right? Just hold and forget, which is not what's happened in index. But what it is a good question, and you can ask, when's the tipping point? And here I think it's important to note that ownership doesn't set pricing, trading sets pricing. And so you can actually do a little mental experiment. The average turnover in the ASX and the S&P 500, both year on year, including reinvestment of dividends, 5 to 10%. So however much assets there are in passive, if they buy and hold passive, they're going to turn over, they're going to trade about 5%. The remaining active investors, what's their typical turnover? Well, look, it varies. Some trade all day, some trade less frequently, but about 100, roughly 50 to 100% per annum. We are, and this is why I put this slide up, we are roughly 25%-ish passive in the US. So there's plenty of room to run. Even at 90% passive, which I don't think will ever happen, even at that point, the majority of trading will still be done by active investors. There's actually lots of room to run. But thank you for the question. It's a good one.
Yep.
Hey, Tim. Great presentation. Question around the proliferation around the number of indexes available.
Yep.
Does that have, I know that there's more indices available than there are stocks.
There are.
Now, does that, obviously, S&P being an index business, the more the merrier, but does that ever warn you, or I guess, concern you around the number of types of strategies that people are trying to achieve, alpha, bringing out thematics, bringing out these new indices?
Yeah.
There's just more and more coming to market. Is that encouraging for you, or is that a concern for you?
Yeah, I do think there's a point at which it can get a bit confusing for investors, and there's sort of too many choices, and I think that can be an issue, but I think that is to some extent. Look, there are far more actively managed funds than there are index funds. The fact that there are so many indices is sort of more. There's more things going on there. It's a bit like, do you know there's only 26 letters? You see how big the dictionary is? Let me explain what I mean by that. So take, for example, our global broad market index, the global BMI, right? So that's one index. We publish it in 12 currencies, 12. Total return and price return, net total return, okay, times 3. We also publish all the 51 countries that are in it individually, so times 50. We publish for all of those, all 11 sectors of those countries, times 11. We do large, mid, small, growth and value. They're actually, just to have, such things as the Vietnamese mid-cap technology index priced in pound sterling, so that we've got all of those, and maybe no one ever looks at that, that's 100,000 indices. So yes, we do publish a lot of indices, but there's only actually a few that matter intensely to the investment market. And I do think, how could there be so many? Relax, right? They represent sometimes just benchmarks, or sometimes just showing you what's going on in regional banks in Vietnamese dong. Maybe no one looked at it, but it's there if you want it. Thank you.
One last. Yep. Oh.
One last question.
Hey,
Might have to be a yes/no one.
just quickly. So, just with your analysis, that's all long-only equity funds that you can
Correct.
refer to. So, have you ever done any work around market neutral? I mean, maybe all the good stock pickers have gone to hedge funds.
So that may well be the case. We haven't done the analysis. I will say, it's kind of fun fact. There was did you see the famous bet that happened? So this was one of the best salespeople for index funds has been Warren Buffett. That is the only data point that I really specifically have. For those who don't know, it was a bet made between a fund of funds manager and Warren Buffett, and they could pick 10 of the best funds they could find, and it was $1 million bet, and would they beat the S&P 500? They did not. It is generally true that outperformance is hard. We have hopes to cover more institutional long-short strategies, but at the moment we don't. It's also a bit of a challenge on what's the right benchmark. But
Thank you, Tim. Please
Now,
thank
now
Tim
we
for a
also
great
assess
presentation.
active versus passive presenters, and you're currently on the outlier active presentation.
thank you.
Thanks, Tim.